Okay, now this part is really, really important. Make sure we really understand this. See, this is something called, oh, hang on, I'll switch my screen. See, here, this is something called Fed balance sheet reduction, which means to QT is the opposite of printing money, the opposite of QE. Do you remember all those memes that you see online about Jerome Powell, who's the chairman of the Federal Reserve, printing money? Remember all these memes? He's like going crazy and printing all this money, and that's why people tell you to buy Bitcoin. Well, now they're about to do the opposite. They're about to show you that the Federal Reserve actually has some self-discipline as well, and that's called, instead of quantitative easing, it's called quantitative tightening, QT. So what they do this time is basically they're about to basically tighten this the balance sheet, or how many bonds that you have bought. And see, it's very important. It says here, Fed balance sheet reductions almost always end in recession. And by the way, as always, this video goes out to my Discord members and friends first, and then basically a few days after that, I will put it on YouTube for our fellow members and followers to see. So here it's something that's really, really important. I think we previously just covered that every time basically when the Federal Reserve, raises rates, it's nothing to be scared of, right? I mean, we just saw that every time when the Federal Reserve, say for example here, raises rates, it's nothing to be scared of, because it's rates go up, but the markets also go up with it. It's QT we need to be worried about. So for example, like say what happened here. See the purple line that went down here caused the SP 500 to drop 20%. That's bear market territory. And that also has implications for Bitcoin as well, because Bitcoin is seen as a risk asset. If the SP 500 goes down 20%, chances are Nasdaq goes down 30-40%, and then Bitcoin probably goes into a small bear market, if not a large bear market as well. So now, without further ado, let's see what they mean. So now the Federal Reserve, for example, has, it says here, right, Federal Reserve's looming attempt to shrink its mammoth portfolio of bonds comes with an ugly track record. Virtually every time the central bank has tried in the past, recession have followed. Virtually every time. Oh, come on. Virtually every time the central bank has tried to what's the word, QT. And this article was written 2 years ago when the Fed balance sheet was only 4.5 trillion, as you can see here. Now guess how much it is? It's $9 trillion. These are the 6 times this has the Fed has tried this before. QT, or selling off their bond portfolio. It's what everyone, Wall Street, what everyone's talking about. This is going to impact stock market and Bitcoins a lot, and the Fed's about to do it. In 1921 to 22, 28 to 1930, in fact, you could argue that's what caused the Great Depression, because the Great Depression started in October 1929, and 1937, 1941, 48 to 1950, year 2000. And also, may I add, we've just shown you also in 2018. Now, we all know what happened in 2018, right? This is it caused the stock market to go down into bear market. This is the SP 500. Nasdaq went down even further, and you're like, oh yeah, but what happens to Bitter coins? Well, let me show you what happened to Bitter coins. Bitter coins in that period has gone from come on. Bitcoin. Okay. Yep, in 2000, well, we all remember that Bitcoin basically went through this massive, oh, here it is. It's this line here. So this is what happened to Bitcoin in 2018. Look at this. Look at this. This is just remarkable. I'm going to change the color of this line so you guys can see it better. So this is Bitcoins. Let's say change it to red. Okay. So the purple line, as the Fed started QTing, quantitative tightening, right, the stock market plunged 20%, which is a bear market, by S&P 500 standards. Nasdaq went down even more in a bear market, and look at Bitcoins went from I remember it was like 20,000 all the way down to 3,000. This is, remember, it spent 2018 doing that, right? And then when the Fed stopped, Bitcoin started rebounding up, and that's the red line. Okay, so now we're at this juncture where the Fed is about to print again, is about to quantitative tightening again, and so it's make that 7 out of 7, right? 21, 22, 28, 30, 37, 41, 48, 50, 2000, 2018. Every time, basically, when the Fed tightens like this, risk assets go into a bit of a crash scenario. SP 500, that means Nasdaq, that means Bitcoin. So, without further ado, I'm going to describe why this time it is different. Why this time it is different. Now, because simply, we are now looking at historically high inflation. By the way, look at this. Tell me what you see here. Now, that yellow line, the yellow line on here is inflation in the United States. It's now at 7.8%, right? 7.8%. This chart actually hasn't been updated yet, so 7.8 would be about, 7.9 would be about here. And see, have you noticed, inflation has not been this high for a long time. It's like, goes all the way back to actually the 70s. This is a different CPI measure. This is the only one I could find on TradingView, but it tells us at least what is happening. Gives us a rough indication of what's happening with inflation. Now, actually, inflation right now is kind of up to here. It's as high as what was happening in the 70s. Now, let's have a look straight away into what's happening in the 70s. Do we see? So here, let's see. And this is, I just like to say beforehand, this is going to help us understand what's going to happen with Bitcoins. I understand people only have questions for Bitcoins, and they don't care about what happens to the stock market. Well, as you've seen, that Bitcoin and stock market has high correlation. A lot of, especially the tech stocks, if tech stocks were to crash, have a 30-40% crash, then Bitcoin's going down. Tech stocks, Nasdaq has only gone down 20% right now, and Bitcoin's down 53%. So without further ado, let me get back to it, and we will look at what happened. The big similarity, why I think this time, when they start hiking rates, markets probably won't go up, or it won't go up anywhere near as much like in the past, is because we have to go back 40 years to see what happened last time. Now, 40 years ago, essentially, 50 years ago, half a century ago, now we had inflation which was around 10%, 11% type of inflation. And you can see that as inflation was rising, interest rates, inflation's the yellow line, interest rates is this blue cerise line, and interest rates were rising. When interest rates rose, basically, initially, see, between here and here, the stock market still rose a little bit and then quickly crashed. Now, this is actually not much of a rise. So starting from this point, the stock market is at 104. This is the SP 500. And at the top, it's at 119. So that's like a 13% move. The stock market went up 13%. That's still something. Could still make the Bitcoin bounce really hard to 69K, even make Bitcoin go above 70K, and then a few years later, inflation came down, but it was still staying elevated. So we look at the interest rates here, the blue lines that kept on rising again. And as it rose, say the stock market rose again, right? Rose again before interest rates were too high and stock market fell. So what was the stock market here? 87. And what's the stock market here at the top of the run? 140. That's a 53-point move. 53 on 87. That's actually quite a big move. It's something like a 65% increase in the rise in the stock market before it eventually crashed. So this is why people kept on saying it's not scary when they start raising rates. It's not scary when they start raising rates. They're right. Even in the 70s, when there was a lot of, this is the famous, what they call Volker moment, when they raised interest rates to 19%. Imagine interest rates in the United States. I'm not even talking mortgage rates. Mortgage rates would have been like 20-something%. I'm talking like, overnight interest rates that the Federal Reserve lends to the banks. Right now it's at 0 or 0.1, and they're going to move that to 19%. Imagine. That's what happened in the 70s. Imagine how much that would impact the stock market. Now, of course, I'm not saying that will happen this time. I'm not saying it'll go to 19%, but it'll get a lot higher than where it is right now, which is near 0%. And when that happens, stock market keeps on rising. True. Why am I comparing now to the 70s and 60s? Because that's when the last time when inflation, look at this yellow line, was around 9 to 10%, which is where we are right now. But however, you would say to me, yeah, but Pablo, even back then, right? Even back then, you had interest rates rising rising, the stock market was still rising. So why is it that, oh, beautiful moon up there, see? Why should the market freak out right now? Why would the market freak out just because interest rate is rising? Even in the 70s, we had, this time I think is different because inflation is at its highest in 40, 50 years. But because inflation's rising, the Federal Reserve is going to hike rates really kind of fast. If there was no war, the Federal Reserve would be hiking rates right now. But however, there is no, even in the 70s, when inflation was this high, when stagflation was happening, as the interest rates were climbing, stock market kept on climbing. So if Bitcoin was invented back then, Bitcoin as a risk asset should also be climbing. So why are you so worried, Pablo? Well, I'm going to tell you guys the answer now. Okay, folks. So now we got to ask ourselves, what is the difference this time? Why do we think it's different this time? I mean, it's pretty easy to basically just go with, go with the flow and just say that, hey, look, it's going to be exactly the same play again, like what happened here in the 70s, in the 90s. Basically, every time that when inflation goes up, let's see if I can make this smaller so it's easier for you guys to see. Oh. Every time when there is when interest rates are going up, you should be able to see that. So you can see the dates down the bottom. When interest rates are going up, every time the blue lines, interest rates going up, stock markets tend to rise. Interest rates going up, stock markets tend to rise. So by Wednesday, if the Fed raises interest rates again, markets freaked out initially, like they did the last 2 or 3 month event. But sometime after liftoff or after they start raising rates, market calms down because buy on rumor, sell on fact, then they start going up. So what's the big worry? What's the biggie? Even back in the 70s, see, 70, 72, all the way up to 1980s, when interest rates went this high, the S&P 500 was still climbing. What are we worried about? Why do we think the market will crash? Well, here's the key. There are 2 key differences, if not more, in my opinion. Here's the thing. Okay, see if we can see this. Now, can we see this is from 1963 here, 1963, 1966, all the way up to about, say, here, 1982. That's about 16 to 19 years from here to here. Have you noticed that the SP 500 basically went up, down, up, down? It basically just kept on bouncing between this channel here, and then it went up slightly above and then came back to the channel here. So the low end of the channel here is 70. The high of the channel is 105, 106. So it basically bounced for 16 years between the SP 500 bounced between 71 and 106. Here it got up to 140. That's only a 2x. And then back to 106 again by 1982. So what I'm trying to say is, back then, yes, stock market kept on going up because it's been going sideways. It's been going sideways, and as the economy improved, they need to raise interest rates. Inflation was catching on because the oil prices were rising. Stock markets could go up because it was essentially going flat and going sideways. See, going flat, going sideways all this time. And then, so as the economy improved, that's when they were raising rates, the stocks went up. What's the key difference this time? Now, I'm sure when you look at this chart, you will see something very different. Okay, we all know that the this is the E2000 to E2008. The GFC crash went back down to about March 09. That's when they started printing money. Okay, see around here, the stock market essentially went sideways for the last 10 years, the last decade. And then look what happened. Now, look what happened from here. This is 2009, March 2009. Let's see, where was this S&P? S&P closed at 683, 680. Now where is it? Right, okay, now here we are. In this decade, from 09 to, let's say, end of 2021, in those 12 years, 680, close was 4,766. That's an 8x. That's 7 to 7.5x. 7 to 7.5x. That's a very different situation from what happened in the 60s or what happened in the 70s. So you think this time, if they raise rates again, do you think the market will just go a little bit like what happened in the 70s, go down a little bit sideways and then go up, right? Not likely, because this is unprecedented. In the 70s, there's a couple of key differences. In the 70s, what I just showed you, yes, see the yellow line, inflation was super high and they were about to raise rates. But however, they didn't have unlimited quantitative easing. That's what the Fed was saying. They were doing unlimited quantitative easing. They spent $4.5 trillion in 2 years to prop up the economy. They didn't take interest rates down to zero. Now you want to bring interest rates back up again. That's like taking drugs away from a junkie. The market's going to freak out, in my opinion. So one, you didn't have this situation where, I mean, even just look at this. Even just look at the last 1.5 years. So where is this? This is March 16th, March 19th. Okay, the low here was 2280. 2280 was the low, and the high was what? 4808. So it went 2.3, 2.4x. 2.3, 2.4x the stock market in 1 year and 9 months. In 1 year and 9 months, the stock market did a 2.3x. That's, I mean, the entire almost 16, 17 years in the 70s, the stock market didn't do a 2.3x. Now the stock market, S&P 500 did a 2.3x within 17 months, not 17 years, 20 months, right? Not 20 years. So that's why if you start raising rates now, this is going to react. Second of all, let's not forget they didn't do QE or quantitative easing back then. So have a look at this. Now, oh, come on, where is it? Come on. As I just showed you guys, there is. Can we not see that? One second. Okay, so the situation is obviously very different this time. See, because look, you can see here is the most recent chart First of all, it's been a crazy run up in the stock market. Second of all, I mean, look at this. Before, you didn't have, in the 70s, you didn't have quantitative tightening because they didn't print money back then. They didn't print 9 trillion US dollars worth of money, so they didn't have to tighten like this. They didn't have to take liquidity, take money out of the market. And look at this. If they do this, it caused a crash here, 20% crash. That's a bear market in the SP 500. So the key difference is, if you're comparing how the stock market and Bitcoin's reacted to the last 10, 20 years of interest rate hikes, then you're missing the point, because the last 2 years, the Fed has been very slow in raising interest rates. Look, I'll show you. Like if you look at this, see, this is where they started raising interest rates. This is June 2004. This is to June 2006. So that's 2 years. 2 years, interest rates went from what? That's the Fed funds rate. The yellow is the Fed funds rate. Interest rates went from, where is this? From 1%? Yep. From 1% up to 5%. So they basically raised 4% in 2 years. Yeah. It took them 2 years to raise these interest rates. Whereas right now, they might do it twice as fast. And remember, all of this, the purple graph was rising. That means they didn't do any QT, right? Right now, they're thinking of doing maybe 2%, of raises in 1 year. Whereas here, they were doing 4% in over a matter of, well, okay, that's still pretty fast. But what I'm saying is, right, the Fed used to do rate rises quite slowly, whereas right now because they were only facing inflation that was under 3%, under 2% sometimes. Now they're looking at inflation that is around 8% before you factor in wheat, copper, gas, oil spikes due to the war. And when those figures come through in, say, March, for the April and the May CPI numbers, we can see inflation at, say, 10%, 12%, 13%. So you can see here, basically, there's, I'll show you one more thing. Let's see if we can open this. All right, might as well just do it. Yeah. So this is the USO2 2-year yield. Now, essentially, we're in a different sort of environment, because before they used to raise rates slowly, but now basically they're going to do it a lot faster, because this was when these sort of things happen when inflation was around 2 to 3%. Now inflation is probably something like 10, 12%. So they're going to raise rates much faster, and the purple line is when they quantitative tighten, say here. They're going to quantitatively tighten a lot faster as well. How do we know this? Didn't the war, everyone's probably thinking, what about the war? Didn't the war stop the Fed from raising rates? They're worried about the war. Okay. This is what the market is predicting. See, this is the US government 2-year bonds, which means that they're trying to guess what is the average, bond yield, or what do they think is going to be the average Fed funds rate, so to speak, over the next 2 years. And see what happened here is this. You see that this is the weekly chart. We'll put it onto a daily chart. What they're saying here is essentially over the last as soon as the war started, around, say, Feb 24th, from my memory. Do you see Feb 24th? Yields started falling off and make some big falls. It went from 1.57% down to a low of 1.26%. So almost a 30 points drop. So they thought, okay, the Fed probably isn't going to tighten because there's going to be a war. But in the last 2 weeks, look what happened to yields. So now, today, it's shot up to 1.83, right? Today's March 14th. It's shot up to 1.83%. And it's higher than before the war in Ukraine. So what this means is, yes, when the war started, people were like, okay, Federal Reserve probably isn't going to raise rates as fast, so rates tanked. And then they were like, inflation's 8%, inflation's getting worse. So they're like, yeah, we don't care about the war anymore. And now yields for the next 2 years, the market is betting on it's going to be higher than what they were saying even before the war. That's how concerned they are about inflation. It's not only the 2-year, the 10-year, US 10-year yield. You can see this is today, 14th of March, has also shot up to a new high compared to before the war. This here is when the war started, right? This here is when the war started. Yields went down, and now yields are higher than before now. So what all of this is telling me is that, first of all, the war, as we just saw, isn't going to slow down tightening in the market's opinion. Usually they're quite accurate about these things. Number two is that because inflation is so high this time, the Fed will hike rates much quicker than what we saw in the 1990s, 2000s, and the teen years, 2010 to 2020, so to speak. So because of that, interest rates are going to go up a lot faster, because back then the Fed was only dealing with like 2%, 3% inflation. Now they're dealing with 12%, 13% inflation, which we're going to see in the next 2 to 4 months. So that makes the situation very different. I would hesitate to compare examples from 1990 to say 2020. Now, so then we looked at a period where there was huge inflation back in the 70s and 60s. And we saw that the stock market was still rising as the rates were rising. Now, and we explained, just to sum up, that yes, that is true. As interest rates was rising, as the Fed was tightening, stock market still rose, which means Bitcoin could probably rise. But keep in mind that the stock market of the 1960s and 70s went sideways, right? From 70 to 105, that's the SP 500, went sideways until the end of the decade, and then it came back to, right, 106. Whereas the stock market today, in the last, look at that, that's the last 12 years. It just went 7x, that's the SP 500. Nasdaq went even harder than that. So it's, if the stock market we have today, after going 7x, 6.5x, if it pulls back by say 20, 30%, then don't you think that's quite normal in a fast tightening cycle? Second of all, in the 70s, the example we just saw, they didn't have quantitative tightening. They didn't have QT. Now, and now we're about to have QT. We just don't know how big the QT is going to be yet. And why are we worried about QT? Remember this article? It says, whenever this QT has almost always ended in recession. QT almost always ends in recession. This happened, we'll say this again, 21, 22, 28, 30, 1937, 1941, 1948, 50, 2000, and 2018. So those are pretty strong arguments that this time it could be different. This time, when they start raising rates again, when they start QTing again, it could be different. The market has been pricing in QT, and it's easy to price in QT, and it's easy to pricing what that will do to the stock market. Because you can calculate how many rate rises there are going to be. Is it going to be 4 or 8 or 12? every time you raise rates by 25 basis points, you essentially go up 1 percentage point. So basically, it's easily predictable. But however, QT, in the modern day, QT has only been done once in the modern day. So how much is the Fed's going to QT? We don't really know. It could be anybody's guess because it's only happened once in modern day situation. And second of all, how will that impact on the market? How will that impact on the long-term yields? We don't know. It's a totally unknown situation. But what we do know is that every time they QT, it caused a recession, pretty much. And 7 out of 7. And if there is a recession and you still have inflation that's that high, then that means stagflation. In a stagflationary environment, which means high inflation and recession, no growth, stagflation, then in a stagflationary environment, risk assets tend to tank really hard or crash. So that means stocks are going down, Nasdaq, tech stocks are going down. Usually if tech stocks crash, as we've seen, tech stocks is down 20% right now, Bitcoin's down 53%. If tech stocks go down 50%, I mean, I'll just give you an example. Look here. This is what happened when tech stocks went down 50%. Sorry, I'll use this one. Okay, let's see. Tech stocks went down. This is the day when tech stocks went down 50%. That was during the COVID crash. And we all know what happened to Bitcoin. So the close here was 9718, and the low here was 6771. Okay, so that's only a 30% decline. That was only a 30% decline in the Nasdaq US 100 index. And look what Bitcoin did here. I think the Nasdaq might have gone down even lower. This is just from memory. Let me check out the QQQ. Just quickly try the QQQ. QQQ is the ETF for Nasdaq. Let's see what happened in March 2020. Come on. Oh. Okay. The high here was 237 and the low was 237. The low was 164. 237, 164. That's 73 points. So that's about a 30% decline here as well. Okay, so that was a 30% decline, but look how much Bitcoin went down during this period. Let's see. If we graph it against that, in the same period, see this is Bitcoin. Bitcoin here is, come on. Yeah, Bitcoin here is, hold on, let me just adjust the numbers. Bitcoin. Okay. Bitcoin went down in the same period when stocks went down 30%. Bitcoin went from 10,164, that was the close, went down to 4,800. Yeah, so Bitcoin went down something like 53% when Nasdaq went down 30%. So in other words, Bitcoin goes down a lot more. It's a lot more sensitive than the Nasdaq. So if we are to see a recession, we will see SP 500 go down at least 20% into bear market territory. We will see Nasdaq go down 30, 40. It's already at 20, 30, 40%, maybe even more. And we will see Bitcoin go down more than the Nasdaq, as we've seen many times. Now, I could be wrong, and there could be, as we see here, as usual, a rebound in the market as they start lifting rates. So from March 16th, there is a somewhat of a chance as the market, as we see here, the purple line, the blue cerise line, as the market starts raising rates, stock market actually goes up, right? Goes up. And it's only when it stalls and it feels like there's recession coming and rates start coming down, then the stocks crash and Bitcoin crashes as well. That could still happen. I think we got to be extremely careful because this time is different. Yes, we all understand that's what happens every time. But I'm trying to warn everyone that this time is different because this time they can do QT. And unlike in 2018 when they did QT, this time they're going to do QT harder and faster because back in 2018, inflation was at 2%. Now inflation's at 12%, probably. Yes, they're going to raise rates this time, but they're not going to raise rates slowly. They're going to raise rates fast this time because inflation is so much higher this time. And even if we compare to the 70s and 80s, yes, they're going to, raise rates. Yes, there was high inflation, just like today. Yes, they raised rates quite aggressively. But however, remember back then, stock markets were going sideways. And now stock markets essentially, have just taken off 6-7x. So it's very, and they didn't have QT or QE back then. So it's a very different situation, very different environment. If stocks and crypto do go up as they start raising rates, I don't expect it to go up another 2-3 years before it turns down. And then I think this is going to end within month, like the end of this year. If we're very lucky, we might get another bounce. Bitcoin might try for another new all-time high by the end of this year, something like that. But think about the risk rewards. It's a lot of risk to get that reward. I can't be 100%, but I'm just saying situation's very different this time. I would not be surprised if stocks and Bitcoin do not make a new all-time high before turning down. Situation is very different this time. And thank you for following me along. And, this, of course, is shown to my Discord first before I'm putting up on the social media. Thank you for your time, and I'll catch you another time. Cheers. Bye-bye.